Hello guys! Welcome back to Professor Explains channel. Welcome to my deep dive into the world of insurance. Today, we'll explore the foundational principle of utmost good faith and other key principles that underpin the modern insurance industry. These principles ensure that both insurers and policyholders act in a fair and transparent manner. Insurance is a contract between an insurer and a policyholder, providing financial protection against losses. This contract is governed by several fundamental principles, the most crucial of which is utmost good faith. Let's dive into what this means and why it's essential. The principle of utmost good faith, or Uberrimae Fidei, is the cornerstone of insurance. It mandates that both parties, insurer and insured, must disclose all relevant information honestly and fully. An insurance contract is based on the principle of utmost good faith, that is, a higher degree of honesty is imposed on both parties to an insurance contract than is imposed on parties to other contracts. For example, when applying for health insurance, a policyholder must disclose all pre-existing conditions. Failure to do so can result in denied claims or voided policies. This principle has its historical roots in ocean marine insurance. An ocean marine underwriter had to place great faith in statements made by the applicant for insurance concerning the cargo to be shipped. The property to be insured may not have been visually inspected, and the contract may have been formed in a location far removed from the cargo and ship. Thus, the principle of utmost good faith imposed a high degree of honesty on the applicant for insurance. The principle of utmost good faith is supported by three important legal doctrines: representations, concealment, and warranty. Representations are statements made by the applicant for insurance. For example, if you apply for insurance, you may be asked questions concerning your age, weight, height, occupation, state of health, family history, and other relevant questions. The legal significance of a representation is that the insurance contract is voidable at the insurer's option if the representation is material, false, and relied on by the insurer. Material means that if the insurer knew the true facts, the policy would not have been issued, or it would have been issued on different terms. The doctrine of concealment also supports the principle of utmost good faith. A concealment is intentional failure of the applicant for insurance to reveal a material fact to the insurer. Concealment is the same thing as non-disclosure, that is, the applicant for insurance deliberately withholds material information from the insurance company. A warranty is a statement that becomes part of the insurance contract and is guaranteed by the maker to be true in all respects. For example, in exchange for a reduced premium, a liquor store owner may warrant that an approved burglary and robbery alarm system will be operational at all times. Or a bank may warrant that a guard will be on the premises 24 hours a day. So, the key point is full disclosure. Insurers, on the other hand, must clearly outline the terms, conditions, and exclusions of the policy, ensuring the policyholder understands the coverage. This mutual transparency builds trust and ensures that both parties are protected. Another fundamental legal principle of insurance is insurable interest. This means that the policyholder must have a legitimate interest in the insured item or person. For instance, you can insure your own home or car, but not your neighbor's, because you do not suffer a direct loss if something happens to their property. So, the key point is legitimate interest. This principle ensures that insurance is used to protect genuine interests and not for speculative purposes. The principle of indemnity ensures that insurance restores the policyholder to their financial position prior to the loss, without allowing them to profit from the insurance claim. For example, if your car is damaged in an accident, the insurance will cover the repair costs, but not more than the value of the car before the accident. So, the key point is no profit, just restoration. This principle prevents policyholders from making a profit from their loss, maintaining fairness in the system. Principle of subrogation allows the insurer to step into the policyholder's shoes and claim reimbursement from the third party responsible for the loss. For instance, if another driver damages your car, your insurer can cover your repair costs and then pursue the at-fault driver or their insurer for reimbursement. So, the key point is recovery from third parties. This principle helps control insurance costs by ensuring the responsible party ultimately pays for the loss. The principle of contribution applies when multiple insurance policies cover the same risk. Each insurer contributes to the payment of the claim in proportion to the coverage they provide. If you have two health insurance policies, both insurers will share the cost of a claim, ensuring no double recovery by the policyholder. So, the key point is shared responsibility. This principle ensures fairness and prevents policyholders from benefiting disproportionately from multiple policies. The principle of loss minimization obligates the policyholder to take all reasonable steps to minimize the loss or damage to insured property. For example, if there's a fire in your home, you must try to extinguish it if safe to do so, and not just wait for the insurance to cover the damage. So, the key point is duty to minimize loss. This principle encourages proactive behavior and reduces the potential severity of claims. As per the principle of causa proxima, when a loss is caused by more than one causes, then the nearest or the closest cause should be taken into consideration to decide the liability of the insurer. The nearest cause should be insured by the insurer. Only then the insurer liability comes into picture and policyholder will be paid. The insurer will not be liable for the farthest cause. For example, a cargo ship base was punctured by rats, and because of that puncture, seawater entered the ship. If you look at the events, there are two reasons for damage of ship. 1. Rats punctured the base of ship, farthest, and 2. Seawater entered the ship, closest. In this case, the insurance company will have to pay because the ship was insured against seawater entering the ship and that reason was closest. Understanding these principles, utmost good faith, insurable interest, indemnity, subrogation, contribution, loss minimization, and causa proxima, is crucial for both insurers and policyholders. They ensure that the insurance industry operates fairly and efficiently, protecting against risks and uncertainties. Thank you for joining us in this exploration of the principles of insurance. Remember, insurance is not just about protection but also about trust, fairness, and mutual responsibility. Please comment your thoughts about insurance principles and utmost good faith in insurance. Also, don't forget to hit the like button and share it with your friends. And for more insightful content, don't forget to subscribe to Professor Explains channel. Thank you for watching. Keep track of more videos soon. Please like, share, comment, and don't forget to subscribe down below.